Hello, my name is Tete Moa. Today we're going to talk about insurance. Not only any insurance, but FFS insurance. I'm sure we all heard of it. It's about this guy who makes $1 million a month. $1 million. And I'm sure all your friends or your cousins selling it too. So let's kind of take a look at two flaws with the FFS Life Insurance program. The first one is, every time you go to their meeting, they always talk about the last 10 years, the last 15 years, how the market's so crappy, and you wanna have a policy that will protect you during a down environment. And so they always show you a graph, and they always show you, oh, if you have our policy and which is linked to the stock market, but it never goes down, it always flatlines, you will never lose your money. And that's why they're selling their product, because they think that it's so cool to have this flatline that if this market ever happens again, you won't lose any of your money, but if you had it in the market, you'll lose all your money. But basically, let me show you a graph. Not really, but let me show you some numbers. If you had $100,000 in the market 10 years ago, and you put that into a 401k retirement, and you put it into just an S&P index fund, and you got the S&P rate, you would only have $132,000 after 10 years. Now, if we do the same thing, and if we put that $100,000 into a index fund, which only goes up on the up years, but there's a limit, a 12% limit, and never goes down on a down year. When the S&P went down 30%, it wouldn't go down, it would just flatline. You would have $196,000. That's a lot of money over what you could have done in S&P. But have you ever thought about why they didn't show you the graph for the last 15 years, the last 20? What about the last 35 years? Have you ever thought why they didn't show you those graphs? Because when they do, their product is crap. So if we have the same $100,000 and we put that $100,000 into the S&P index fund in 1975, 35 years ago, a typical 35-year, a person's working life is a typical 35-year, and we look at that account today, we would have $5.8 million, $100,000 that day, and we don't put anything else into it now. But if we had the same thing and we put it into their index, their FFS index fund, which flatlines at 0 and caps at 12, we would have $1.7 million. And so when you do the math, if you're not that smart, that's a $5 million mistake if you join this crap policy. That's one thing that they don't tell you. The other thing is fees. Wow, this is getting really long. Fees. I bought a $100,000 policy when I was 27. I paid $50 a month. And when I asked recently, I got into this because people are trying to get me to join, but I wanted to know about this crap, and so I got into it. And I emailed them and I called them. Some people sent me some forms, and they said, from your $50, we take $27 of it, and we pay administrative fees from your $50 that you pay each month. And then from that, the rest of it, they take another $10 to pay for my insurance policy in case I die. And then from that, they take the remaining amount, which is like $20, and they invest that into the investment. And so really, when you put down $50 into your investment, $25, $30 of it is going to the stupid rep that sold you the policy, and the other 10 is really how much the insurance costs, and the other 20 is what's really going to your investment. In the meantime, you could have just put in the $50 into a 401k, or you could have put in the $50 into a retirement plan or an index fund, just an S&P index fund, and when you invest $50 with that, you're really getting the $50 from it. Sure, the expense fees are 0.01%, 0.05%, but really you're still getting all your $49.96 worth, and not just $20 worth of your $50. And so that's the second problem. But that's all I have time for today, because I'm driving to Fresno, and this is my car blog. I hope you guys enjoy. Maybe some other time we can talk some more about FFS. See you later. Woo!